don't give a fuck if you love me. I don't give a fuck if you like me. Asking me how did it feel? Can't say it didn't surprise me. Last time I looked to my right, you niggas was standing beside me. How can some people I love hang around pussies who try me? Let's go. What did I miss? What did I miss? What did I miss?
Is there a size of business that you would avoid because it gets too complicated, or is it always the same?
I would say companies doing more than 2 million in earnings tend to be real businesses. What I mean by that is they tend to have really strong management and teams in place. It's not an accident. They made $1 million not once, but twice over. And you quite often get the feeling when speaking to these business owners that they are certainly not desperate for a sale. Not that the other business owners are desperate for a sale, but there is a feeling that these guys know, they've read enough articles to know that at 2 million in earnings, they certainly can command multiples of, 5. Depending on the sector, potentially 6, right? Arguably 6. And so I think the minute you start trying to buy businesses that generate millions, with the first millions being 2 and above, something changes. So I would say if you're watching this show, you should probably, in all likelihood, focus on businesses doing under 2 million in earnings as your sort of target demographic, unless you have a different strategy. I mean, a lot of people have access to committed capital. So either through a fund or through structured relationships with individuals with capital, high net worth individuals that are giving you soft promises that have said, look, on these specific terms, they're willing to back your deals, where they understand that you're probably going to do low leverage deals. So maybe you're only levering, 50% debt, the other 50% being a combination of equity and seller finance, right? And maybe 30% of that is in the form of equity through committed capital, even if it's a soft commitment. I think if you have soft commitments, do whatever you want. But if you're sort of taking the alternative approach, which is to first start with finding deal flow and then lining up debt in the form of credit offers, and then finally looking for the equity to do the deal flow, that equity, I would highly recommend that you focus on companies doing $500,000 to 1.5, maximum 2 million in earnings, and then trying not to pay multiples higher than 4 or 5. Because the higher the multiple, in theory at least, the higher the risk. The more time is required for you to cross the break-even threshold. Now, in practice, obviously, there's some nuances. It depends on whether your debt is amortizing, i.e., are you paying down the principal over those years, or is it interest only with a bullet payment, in which case, well, maybe it's not that risky. It depends on if you're buying a business that literally has baked in reoccurring income, such that there's no threat to the income dissipating over time, and you are gonna, if you buy a toll bridge company, for example, right, that's a company that's gonna keep generating that income in a very sustainable manner. But generally speaking, if you're buying entrepreneurial type businesses, SMEs that are doing, call it 5 million, 15, 25 million in revenue and under 2 million in earnings, I would say focus on those companies. Right? Don't try to swing for the fences. First of all, you're unlikely to close. Second of all, even if you do close, you've probably overpaid for that business. You've probably signed up and subscribed for a 7x multiple. And I think that's where things start to get hairy. $500,000 in earnings to 1.5 million in earnings, as much as 2, and try to pay between 3.5, maybe 4 times those earnings. That's the sweet spot. If you can figure that out, that's the value unlock. And that's my advice, man. That's not a very good feeling, right? And also it's harder to explain. Secondly, the recourse is 0. Another location with questionable, dodgy sound quality. I don't know who runs this show. It ain't me, I can tell you that. Because I'm not the one choosing locations.
What's your take on buying very large businesses, and does it look the same compared to small, medium enterprises?
So the question of to buy a large business versus not buying a large business, I think firstly the question is, what is a large business? So I would say that a large business, by my definition, is something doing 8 figures in annual revenue. So 10 million pounds, dollars, euro, and above. Ideally profitably. For my book, that's not a small business, at least. It can be a $10 million, 10 million pound small business, right? Process is basically the same. I think maybe one of the things that changes is the multiple. So the smaller the business, let's say closer to $1 million to $3 million in revenue, the more likely that you're paying, call it 2.5 times earnings. The larger the business, let's say the closer to between 10 and 50 million in revenue with, let's say, 10% profit margins, right? So that would be, call it $1 million to, let's say, 5 million in earnings. Then the more likely you are to have to pay those higher multiples. Higher meaning 4, 5, 6 times earnings. But not always. Quite often, you come across businesses that have some scale, have been trading for decades, but given their geographical location, given the sector they're in, for one reason or the other, are just not considered sexy. If you combine that with, a willing seller, someone who has already envisaged themselves and their life beyond, the horizon of being that business owner, you can sometimes get a decent deal where you're maybe still paying a 3.5 times multiple and with structure. So we've done at least one, maybe 2 deals where the companies were not small and we had very, very reasonable sellers and we had reasonable transactions. So I would say the biggest difference is, in theory, the multiple that you're paying, but obviously in practice that changes, case by case. Process is the exact same. Human nature is the same, Oscar, right? Whether you run a business that generates £500,000 in revenue or £50 million in revenue, it's still the same, nature. And at the end of the day, we're in a human business where we're opening discussions with business owners and trying to figure out how do we help them unlock some value. And that doesn't always have to be extremely transactional. That can be some of the softer elements as well. Yeah, that's a nice thing about M&A. I mean, there are no rules, there's only guidelines, right?
So we recently saw GameStop CEO Ryan Cohen
I love it.
not being able to clarify how he was going to fund the $55.5 billion acquisition of eBay.
Yes.
He was sort of mentioning stocks to cash. I thought, why can't he just do an LBO on it? Why are they only talking about cash? Why are they not leveraging?
Oscar, man, Oscar's questions are getting brilliant. So there's this company called GameStop. And historically in the 90s and in the early 2000s, GameStop was a retailer. It was like Blockbuster Video, but for video games. And GameStop just made an offer to buy eBay for, if I'm not mistaken, I might be butchering these figures, I think $56 billion US. Now the challenge is, GameStop is only worth about $15 billion, and yet they're trying to buy eBay that's worth $56 billion. And so the question is, how were they making that offer? Like, how did they even intend on buying that company? And essentially what they did, or what they were offering to do, is a leveraged buyout, right? So GameStop, my understanding is they have some cash in the bank, roughly about $9 billion US in liquid investable assets. That includes roughly $6 billion of cash and about $3 billion of non-cash but liquid assets, so about $9 billion in liquid assets. And then they got an offer from a bank called TD, which offered them about $20 billion of credit, okay? So again, deal flow, debt, equity. What is the deal flow? eBay. They found this company, it's a publicly listed company. eBay similarly has been around for about 30, 35 years. eBay is historically an online marketplace. It was one of the early pioneers of a consumer-to-consumer marketplace, where you've got your shoes and you want to sell your shoes to another private person. Deal flow is eBay. Debt, they got a bank, in this case TD, to offer them $20 billion. Now, $20 billion in debt is literally more debt than the entire value of GameStop, right? So that in itself suggests a leveraged buyout, because what are they offering credit against? Against the value of the target. So the offer from the GameStop CEO was $56 billion thereabouts, half cash, half stock. What does that mean? The cash includes the $20 billion being offered by TD Bank and roughly the $6 to $9 billion that they have on their balance sheet in liquid investable assets. And what he means by stock is they would merge GameStop with eBay and form a larger company, call it GameStop eBay. The shareholders of GameStop would end up owning less stock in the combined group than the shareholders of eBay, which would own more. I think something about 2 to 1, meaning GameStop shareholders would own 1/3 of the combined company, and eBay shareholders would own 2/3 of the combined companies, and the eBay shareholders would also get half of the consideration in cash. Some people are calling it a genius move. Some people are calling it hubris and a very aggressive attempt to swallow something bigger than themselves. But it's been done before. As a matter of fact, when we bought the second steel company, technically we had a smaller steel company called JHT doing about 2.5, 3 million in revenue, and we swallowed up a larger steel company called Steelway, which at the time was doing about 12 million. So we technically did that. We, with a 2.5 million revenue company, bought a company that was doing about 5 times our revenue size and had a combined group that we then named Northern Industries. So it can be done, and he's not crazy, the CEO of GameStop, but it's highly unlikely. The offer of credit that he has, whilst being called a confident offer of credit, is not necessarily secured capital. GameStop actually does not have enough shares. It doesn't have the ability to create enough new shares to allow eBay to swallow it whole. So technically, he's made an offer that he can't yet fulfill. He would have to go back to his shareholders, GameStop shareholders, and get the corporate authorizations to be able to increase the number of shares, the maximum shares that they can issue. So now it starts to get a bit technical and in the weeds, but it's to say in all likelihood, they're probably not going to do the acquisition. And in many ways, it's probably more indicative of a CEO that's very good at PR and marketing, getting attention on his stock, than it is a representation of a bona fide offer that's likely to conclude anytime soon. But nonetheless, very interesting stuff. I love the question. Oscar's clearly all up in this M&A stuff, and I love it, man.
What's your take on younger people starting doing roll-ups of very small businesses like TikTok shops and YouTube channels, aka mini PE?
I don't love this concept of buying a series of tiny businesses and micro companies that do, call it 100,000 in annual revenue. I don't love it because it's just as painful buying a business that does 100,000 or 200,000 or $500,000 in revenue as it is buying a business that does, call it 3, 4, 5 million in revenue. So you're gonna suffer anyway. I think the reason people go after those smaller transactions is because they have a belief system that suggests that it must be easier, or they're disallowed from going after slightly larger businesses. But frankly, I would say it's much more about the earnings threshold that separates the categories of deals. So let's say companies doing under $1 million in earnings is maybe one category. Let's say companies doing between 1 and 3 to 4 in earnings is another category. And then above 5 million is a whole other category. Forget above 5, you're not there, you may never get there. It's extremely hard. I mean, I've never bought a $5 million pound earnings business. That's a whole nother league. I mean, at that stage, you truly are playing in private equity land. I would say $500,000 to about 1.5, 2 million is the sweet spot in earnings. Because that represents a real business where you can actually use debt, actually attract credit, incentivize the current owners, extract some kind of semblance of a management fee that makes it worth your while, all while playing the game. I mean, if you're buying a website from someone that barely makes any money, that's 80,000 a year in revenue, and makes, in theory, 5,000 a year in profits, you're not actually buying shit. All you're doing is like exchanging your time, for however they currently spend their time. It's not an M&A, it's not a buyout. At best, it is, I don't know, man. At best, it's like employment, right? So it's like one form of self-employment for another form of self-employment. Totally fine, but what I'm advocating for is actual business ownership in sustainable businesses that generate earnings, that have management teams in place, that don't require your labor after you've done the transaction, such that the value you bring is as a resource aggregator, as opposed to being a human resource in yourself. So that ain't for everyone, man. And all I can help you do is maybe buy a real business, should you be so inclined. I have to say, Oscar, your ability to ask questions is getting quite awesome.
Nice.
And You caught me off guard today with that GameStop question.
Yeah.
Because what that suggests to me is you are a man in the arena. So here we are, we're trying to buy small, medium-sized companies in the UK that are doing, $500,000 or $2 million in earnings, and we're using leverage, and we're making offers, and we're unsure how the owners are going to react, okay? And we're putting those offers, we're submitting them through letters of intent, right? And we're then entering a dialogue with the business owners and trying to negotiate. We are onboarding credit institutions and getting the banks excited, trying to back the deal. We're doing all of that. And then you have GameStop doing the exact same fucking thing at scale, and it's exciting, right? So those guys, they're trying to go 12 billion to 56 billion, and we're just trying to go 0 to 100.
Oh, that was beautiful.
Ah, you got it, huh?
Oh, that's perfect.
Okay.